The stock market is insane right now. The S&P 500 is down nearly 18% year to date in 2022, but has been down as much as 23% at times this year. Additionally, we just got confirmation that inflation for August was even worse than predicted, including an 11% year-over-year increase in the cost of food. Things are not going great, and I have received quite a bit of feedback asking how to protect your investment portfolios from a stock market crash. So let's talk about it. Here are 4 different strategies for the average Joe out there to analyze and protect their investment portfolios. Okay, so this first strategy seems ridiculous, but it needs to be stated and then fully explained. Do absolutely nothing. When I say do nothing though, what I really mean is do not sell everything at market lows, and also let's maintain a proper perspective here. So many people freak out when their investments go down in value, but way too many of these people are freaking out for no reason at all. The majority of investors are investing for retirement in the future. The stock market has also been proven historically to go up over time. Now, that doesn't mean it's a smooth ride. There are ups and downs along the way. Sometimes it seems like the floor is falling out beneath you, and other times the markets are flying high and fast. But over the long term, the markets go up. If you are not retiring in the next 5 to 7 years, why on earth are you freaking out? You have time on your side. Additionally, you have the ability, when the stock market has dropped significantly in value, to add even more money to your portfolio at extreme discounts. Now, I get it. I was there when the housing crisis happened. Many people lost their jobs and many companies went out of business. That was a scary time to have money in the stock market, and even harder time to think about investing even more of your money. Same thing goes for the 2020 COVID crash we experienced. Even if we decide not to add new money to our portfolios, we should always have a 30,000-foot fresh perspective and view of the situation. History tells us the stock market has always bounced back and made new highs. If you have 10 plus years until you need the money, I personally think this is the very best strategy you could implement. It really is hard for me to even identify a downside to this strategy. Now, for those of you that need your money now or very soon, such as investors who are already retired and living off their portfolio, or investors who will be retiring within the next 3 to 5 years, this is probably not the best strategy for you unless you hold a dividend cash flow portfolio that pays enough dividends, or you have far and away more money than you could possibly need to retire. This is probably not the average Joe though, so let's talk about some other alternatives. The second hedging strategy would be to protect money you need by holding it in cash. This could be investors who need a specific amount of money to pay for a wedding in the near future, or to buy a new car, all the way up to investors who are retiring in the next few years. Cash is king. Cash is also a really great way to hedge against market volatility. For example, let's say you have a hypothetical $1 million portfolio and you were retiring within the next 2 years. Many financial advisors might recommend keeping 1 to 2 years of living expenses in cash and investing the remaining amount. This ensures you have at least a short-term portion of your portfolio mapped out and insulated from market volatility. Of course, in a perfect world, you would know exactly what would happen in the stock market and you would completely switch to cash right before a market crash. But the reality is we just don't know what's going to happen in the future. We might even find ourselves in a situation where we switch to cash at the wrong time. Instead, we can proactively decide in advance how much of our portfolio we need to have in the short term and set that amount aside in cash. So what's the downside of this strategy? Well, opportunity risk. For this segment of the portfolio, you are accepting the fact that you are not going to have any growth of that money. But we need to be okay with this if it's important to us that we protect this portion of the portfolio. Aside from doing nothing, this is the simplest strategy to hedge your portfolio when the stock market crashes. For me personally, I do not hold cash in my portfolio intentionally, as I do not have a short-term urgent need for the money. Okay, the third way the average Joe can diversify their investment portfolios is through investment diversification. In other words, investing in a variety of different investments that are not correlated with each other. This type of investing helps smooth out investment returns. In theory, if you had multiple types of investments and the stock market was down in 1 year significantly, the rest of the portfolio's returns would offset the bad returns from the stock market. When most people hear the term diversification, they think of owning stocks and bonds, having international stock exposure, or even owning different types of stocks. The reality, though, is this type of investment diversification is still very correlated and will likely experience declines at the same time, though perhaps to a lesser extent. Real investment diversification would include owning investments such as commodities, such as silver and gold, physical real estate such as rental properties or apartment complexes, and even peer-to-peer lending such as being the lender for a private party mortgage. These types of investments are not really affected by the overall stock market. And with physical real estate and lending money, the cash flow is not directly affected by how the overall stock market performs. I recognize this type of diversification does take more effort than holding cash or simply doing nothing. However, this type of hedging can bring peace of mind knowing you don't have all of your eggs in one basket and your portfolio will not be significantly impacted during stock market volatility. This will also likely make it easier to avoid emotional selling of your investments at the worst time when markets are down. What is the downside to this type of hedging strategy? It is possible and actually pretty likely that certain years you will have lower returns than the overall stock market, since all of your assets are not in the stock market. That being said though, the benefit is peace of mind. For me personally, while I do own my own home, I do not currently own any other real estate, commodities, or participate in peer-to-peer lending, though I do hope to branch out to rental real estate in the coming years. The fourth way of hedging your portfolio is to utilize options. I'm talking about this strategy last as it requires the most effort and knowledge, and it's the only strategy presented in this video that comes with a very clear cost. There are definitely opportunity costs presented with holding cash and diversifying your investments, but with options you will most likely have to incur an expense to hedge your portfolio. The most simple and straightforward strategy would be to purchase put options. When it comes to buying options, buying a call option gives you the right to buy an investment at a specific price, and puts give you the option to sell an investment at a specific price. Each option contract is for 100 shares of the underlying investment. Here is an example using the S&P 500 index. Let's say you have determined that the S&P 500 index is a good barometer for your overall investment portfolio. You want to buy put options of the S&P 500 so that you can hedge your portfolio. For this, we can look at the S&P 500 ETF, ticker symbol SPY. Here's the option chain for SPY. Let's assume we wanted to protect ourselves for the next 90 days with a put option. The S&P 500 is currently priced at $393.10 per share. We could in theory try to protect ourselves with a put option at a strike price at $390 per share, which would mean any losses below this price would be fully covered by the option. The problem though is this put option is not free. The current price is approximately $17.50 per share, or $1,750. Let's say you wanted this insurance to protect you starting at the 2-year low price for the S&P 500, which is approximately $360 per share, so less insurance. This would still cost you approximately $8.60 per share, or $860 for only 90 days of protection. This type of insurance is not cheap, and depending on the size of your portfolio and how much insurance you're trying to purchase, you might need multiple put options to protect your portfolio. There are ways to buy cheaper insurance by utilizing a put debit spread instead of just buying a put option by itself, but this also caps the amount of profit you can earn. There are other option strategies as well which can hedge a portfolio, but at this point we are adding a lot of complexity that most average Joes will not try to use. And there are more complexities that need to be discussed, including volatility, the decay of option value over time, and more. For most investors with retirement nest eggs they are trying to protect, this type of hedging strategy just might not be worth pursuing when alternatives such as diversification and holding cash are available. Hopefully you found some value out of this video, and please leave your 2 cents down in the comments below and tell me which of these strategies you want to learn more about. Thanks for watching, and check out this video up here to continue learning.